All right, let's talk a little bit about the income statement after simplification. A couple years ago, the FASB, the Financial Accounting Standards Board, changed the accounting standards codification so that there's no longer any extraordinary items. Things that were unusual and infrequent were labeled extraordinary and appeared below the income from continuing operations, and they appeared after tax. That was subject to abuse and a lot of interpretation, and there really weren't that many items that qualified, so the FASB says, let's get rid of that. So like I say, a couple years ago, they came out and said, let's simplify the income statement by eliminating the concept of extraordinary items. So they just eliminated them. They used to be items that were unusual in nature and occurred infrequently. And like I say, they would appear below income from continuing operations. And so now they say instead, things that are out of the ordinary, anything that's unusual or infrequent, gets reported as a component of income from continuing operations and or disclosed in the footnotes to the financial statements. So I like to say that now that we've simplified things, there's really only three sections to our income statement. There's the operating section, the non-operating section, and if we discontinued some operations, there would be some discontinued operations down here. So in this example, if we didn't have discontinued operations, this line here would be called net income. If we do have discontinued operations, we change this line to be called income from continuing operations before tax. Income tax, this is the tax that's related to our continuing operations only. And then our income from continuing operations. Then we would put down our gains or losses either from operating or from selling the discontinued operations. And what makes it a sale of discontinued operations? Well, first of all, it has to represent a strategic shift in our business. And secondly, it has to have cash flows and financials that are separable and distinct. All right, and so in the old days, what would happen is we'd also have down here in this section those extraordinary items, things that were unusual and infrequent. We don't have those anymore. Those things that are unusual and infrequent would be up here and part of continuing operations. Okay, let's do this problem together. The bookkeeper has income from continuing operations before tax of $790,000. And there are 6 items, some of which are going to be used to fix that. So as I read through this, why don't you do me a favor and think, is this an item that's above the line of continuing operations and hence stated before its tax implication? Or is it below the line, income from continuing operations, and hence stated after tax? And you should be offended by those two questions because I just told you the only thing that shows up below income from continuing operations anymore are discontinued operations. Okay, so here's some events. The corporation experienced an uninsured flood loss in the amount of $90,000 during the year. In the old days, that would have been an extraordinary item. Now it just shows up in part as part of continuing operations. At the beginning of 2015, the corporation purchased a machine for $54,000 at a salvage value of $9,000, but the bookkeeper forgot to deduct that $9,000 salvage value, and so was writing off the equipment over 6 years at $9,000 a year when it should have been $7,500 a year. Sale of securities held as part of its portfolio resulted in a loss of $57,000. The president died, so they got a $150,000 insurance policy. It was carried on their books for $46,000. The gain on life insurance is not taxable. They disposed of its recreational division at a loss of $115,000 before taxes. Assume this transaction meets the criteria for discontinued operations. So now finally we have something that's going to come down here below income from continuing operations. And then the corporation decided to change its method of inventory pricing from average cost to FIFO. The changes for prior years have already been made. We go back and we restate our financial statements for those prior years, and it tells us that we were using the FIFO method, the new method, during 2017, so there's nothing for us to do for number 6. So let's fix this income from continuing operations before tax in this numerical order. That flood loss at $90,000 is going to get subtracted to arrive at the income from continuing operations before tax. It's up above that line. In the old days, it would have been extraordinary and below the line. Now it's part of continuing operations. The depreciation expense, we've been writing off $9,000 a year. It should have been $7,500 a year. So we've got to fix that $1,500 for this year only. The prior years got fixed when we restated our financial statements for those prior years. That loss on sale of securities of $57,000 should have been subtracted in arriving at that income from continuing operations before tax. And we had a gain on those life insurance proceeds. It's not a taxable gain, but it's a gain nonetheless. It was on our books for the cash surrender value. We got $150,000 when our president passed away. So $150,000 minus book value of $46,000 means that there's a gain of $104,000. Which means that our income from continuing operations before tax should have been $748,500. That disposition of the recreational division will show up below the income from continuing operations at its after-tax gains and losses. And the fact that we use the right method, the FIFO method for 2017, means there's nothing for us to do with this item number 6. All right, let's figure out our income taxes. Keep in mind that we're writing only one check to the IRS, so we're kind of artificially allocating, doing an intra-period tax allocation between our continuing operations and our discontinued operations. So if our income from continuing operations before tax was $748,500, and if $104,000 of that was non-taxable, that means our taxable income is $644,500. The problem tells us to use a 30% tax rate. So our income taxes on that number of $644,500 must be $193,350, which means that our income from continuing operations must be $555,150. So now to finish up this problem, all we have to do is put in our discontinued operations. It tells us it was a loss of $115,000 before taxes. We're in the 30% tax bracket, so we're going to get an income tax benefit, a tax deduction for that loss. So after tax, it really only costs us $80,500. Income is the $555,150 from our continuing operations, and our net income is the $474,650. For the earnings per share, we'll take this 55,150 divided by the 120,000 shares that are outstanding, and we'll take this 80,500, divide that by the 120,000, and we'll take the net income and divide that by 120,000 shares. So we'll have $4.63 from continuing operations, 67 cents loss related to the discontinued operations, for a net income of $3.96 per share. Let's look at a real life example. Here's Walmart, and you can see that they've got an operating section of their income statement. They've got a non-operating section. They've got a line called income from continuing operations. They discontinued some operations in 2015. And one of the reasons we're looking at this example is they also have consolidated net income attributable to non-controlling interests. So if we own a subsidiary, and we don't own all of them, but we own over 50%, then we consolidate. We put their financials together with our financials. So Walmart owns over 50% of some subsidiaries. They'll put 100% of their sales and 100% of their expenses in here, and then they'll pull out the part that doesn't belong to them. So if they own 60% of a sub, they'll put 100% of their sales, 100% of their expenses in here, and then they'll pull out the 40% of the net income that does not belong to them, but is owned by somebody else who's invested in that sub. Those guys are called the non-controlling interest. So to summarize, in the old days, there used to be a thing called extraordinary items. They were unusual and infrequent, and they were things like floods and fires and condemnations. And we don't have those anymore. So now there's only 3 parts to the income statement: the operating section, the non-operating section, and the discontinued operations section. The discontinued operations are stated after tax. For example, these guys had income on this pizza division before they sold it, and so we allocated to that. taxes of 24,800. When they sold the pizza division at a loss, they got an income tax benefit of 41,000. So after tax, what they had was a $36,000 loss, which took them from income from continuing operations of 276,000 down to net income for the entire operation of $240,000. And so that's really all there is to the new, improved, simplified income statement.